Hello to everyone and thank you for joining us today. My name is Vito Dintrotto. I'm Yarra Capital Management's Chief Commercial Officer, and I'm very pleased to welcome you to today's recorded session with Tim Toohey, our Head of Macro and Strategy, and Joel Fleming, our Microcaps Portfolio Manager. Today's session marks the 9th in a series of weekly updates from Yarra Capital, and these updates form part of our commitment to keeping you informed and connected as we work through the COVID-19 pandemic. Before I hand over to Tim, just a quick thank you for those that have emailed questions prior to today's session, and we'll look to address those sessions at the end of today's formal presentations. And with that, I'd like to hand over to Tim. Thank you, Tim.
Thanks, Vito, and thanks everyone for joining us. Today, we're going to focus on microcaps and the very small companies, small firms' role in the Australian economy, and to link it back through the events of COVID-19 and how we see it impacting. First of all, though, I'd like to start with some common misperceptions, I think, around the micro firms in the Australian economy. On slide 4, you'll see just a range of quotes that I think I've just accumulated over the last 15 or so years of going around doing equity strategy and economic strategy locally and globally. And there is a common perception or a common thread there that microcaps don't really employ very many people. They don't really contribute that much to the economy. They're not overly profitable. They're volatile, etc., etc. And I think Winston Churchill was credited with the phrase, history is written by the victors. But in the case of who gets all the media print and airtime, well, large cap firms obviously dominate and in some ways, I think, overrepresent their role in the Australian economy. And what I mean by that is if we go to slide 5, it might surprise you to learn that when we define micro firms, and this is very much an Australian Bureau of Statistics definition of less than 5 employees, including the principal, or small firms of less than 19 people employed, they actually employ 44% of all people in the workforce, and they contribute 48% of profits across the economy, and a bit over a third of economic output. And if you look at the chart, you'll notice that the micro firms actually contribute more than the smaller firms. So it's a very smaller part of the Australian economy. The very micro firms really do punch above their weight, both in terms of employment and in terms of profitability. Now, if we go to the next slide, on slide 6, you'll see that there is a lot more detail in terms of the employment composition across the Australian industry structure. And I'm not going to go through this in detail, but obviously there are some sectors that don't map to the listed equity market so well, but where small and micro firms really, really dominate. So agriculture, construction, the real estate sector, personal services, obviously are the ones that really do punch above their weight in terms of micro firms. And in the really capital intensive sectors of mining and manufacturing and obviously utilities, they have a very small representation. But if you look across the other industries, it might surprise you to learn just how highly represented the small and micro firms actually are in terms of employment. And if we look at the next page in terms of wages, you will notice that they don't really pay themselves very much. So this is partly a function of the principal doing drawings, but the average salary of a micro firm is basically half the average wage of a typical firm. And when we go up to the next threshold of a small firm, it's a bit under average. So wages and costs, if you want to think of it in that way, are really skewed to the upper and largest firms in the economy. Operating profit, you can see that on the next slide, on slide 8. And again, almost half of all profit is generated by the smaller firms, with those micro firms contributing 40% of national profit. Now, again, that doesn't really fit the common perception and the media representation of how small firms operate in the economy. So they are reasonably profitable. And if we look at the next slide on their contribution to the economy, there is a lack of scale here, of course. So the proportion employed versus the amount of output generated, there is a bit of a gap there. So their productivity is certainly smaller, and that reflects that lack of scale. But nevertheless, this is where the most dynamic part of the economy actually is. This is where the creation and destruction happens most in earnest. And you can see kind of why on slide 10, because the operating profit or the operating margins are actually reasonably high, particularly in the very small firms. If you look at it in terms of the industry composition there on slide 10, with the exception of mining utilities, the margins for micro firms are about, well, almost double that of what you see across the industry average. It's not the same when you go up to the next level for small firms, but at the very, very small level, these firms are actually trading on relatively high margins. Just stepping away from the economic data and having a look quickly at the performance and dynamics around the microcap index. Obviously, you can see there on slide 11, it's been a pretty volatile time in terms of this during the COVID crisis, in terms of the drawdown and the recovery for that matter. But you will notice that over the last 5 years, you still would be well in front of the large cap index if you had invested in the microcaps index. And although we don't really think of this as a place to go to for yield, at least in terms of the aggregate index, the yield is relatively similar. The history of the data in Australia perhaps doesn't go back far enough, but the evidence that we have from the US microcap space is that the total returns for microcaps from 1973 to 2017, we generated about an additional 1% alpha relative to the large cap space by being invested in this space. If we look at the perception around the volatility of earnings in the microcap space versus large caps, well, you'll see that it's actually been less volatile in terms of overall earnings vis-a-vis large cap. And of course, this has partly got to do with what's happened with huge drawdowns in the energy and banks sectors, and then for that matter, in healthcare over recent months in the large cap space. But you'll notice that the price earnings ratio within microcaps has actually been broadly reflective of what's happened in large cap. So there's something going on there with that higher equity risk premium, which doesn't really reflect the earnings volatility so much. It's reflecting the liquidity premium or information asymmetry that's been really reflected down at this part of the market. The impact of the, on slide 13, we've used these charts previously. I think we've done, as Vito said, this is the 9th of a series of webinars. We talked about the size of the fiscal package and the net positive cash flow influence through the balance of this year from the size of this package. It is obviously very large, second largest, we think, on the planet in terms of its fiscal contribution, even though Australia's got the second lowest deaths per capita from the COVID event. And it does leave, we think, Australia pretty well placed to get what we've been determining from the outset as a small V recovery. We will still get this sequential recovery in activity through the second half of the year, albeit leaving our overall output levels below where we were even by the end of 2021. So a lot of employment destruction, a lot of small business and medium-sized business destruction, but in the interim, a relatively, I don't want to call it steep, but I do want to call it a recovery through the next few months, peaking really in terms of activity levels. If we look at really on the chart on slide 14, it's more of a schematic of as we moved into the shutdowns and then the recovery phase. The key point of this schematic is that, yes, we get this V-shaped recovery because the peak stimulus will be delivered as we move through the early phases of social mobility. And that's why you'll get the incremental growth kicking through the middle in the second half of the year. But as we move into that next phase, it's really what comes after that small V that matters. And hence, this is where it's kind of important to think about the ramifications of the fiscal packages through the very small parts of the industry structure and firm size, because overwhelmingly that fiscal package is being delivered to the small and micro firms. There was a range of surveys out from the Australian Bureau of Statistics. One that really stood out was that small and micro firms expected 75% of them expected to receive or utilise the job seeker package, which is miles ahead of what the medium and large firms were indicating. So not only will they be dealing with the package, but it helps mitigate the second round impacts of the crisis that normally would extenuate through a recession and feeding back into the other industries. So we do think that's relatively good news. If we look on slide 15, you can see that we are starting to get this initial points of recovery in some of the business and consumer confidence surveys, which is, yes, it's encouraging. It's very, very early days. We really aren't expecting to see the bulk of the incremental acceleration in activity until really July. We're into that phase where we're basing out expectations are rising. Yes, we're getting mobility movements, and yes, we're getting some traffic and those sorts of things. But in terms of the data, it really won't come through to the July, August, September period when we'll actually see the steepest parts of the acceleration. I don't want to overstate this sort of recovery, but it is important in terms of justifying why the market has bounced to the degree that it has. If you like, the V-shaped recovery is somewhat embedded in markets rather than evident in the data. On slide 16 shows you our net contribution or our net cash flow contribution. Bear in mind all the controversies around the JobKeeper package being underestimated, or overestimated, sorry, in terms of the its coverage to employees and therefore the spend being overstated. That was always embedded in our view in it. So as you can see from the chart, the blue bars at the top, in essence, was us spreading out that JobKeeper package all the way through 2021 on the view that only about 60% of it was ever going to get delivered in a 6-month period. So it doesn't change that analysis one iota, but it also shows you that through that April-May period is when we're actually in negative cash flow versus moving into very much positive cash flow environment over the course of the June, July, August and September periods. It does leave us still with this issue in 17 on slide 17 of what do we do in that 21 period, because we still move into that environment of it still not being enough to offset all of the fiscal fade. Well, the government still has options, and as of today, we're seeing another sleeve of that in terms of their job builder program, which is more of a skills-based program, but it's really a foray to a range of industry policies that we think will be delivered over coming months and into the budget at the end of the year. The biggest arrow in the quiver is to pull forward the income tax cuts. As you can see, it's a percent of household income. They're pretty chunky, and the 22, 23 and 24, 25 increment could easily be pulled forward to that 2021 year. We think it's the easiest thing to do. It's not overly expensive, and it would help mitigate that fiscal fade. The point of all of this is to suggest that if the fiscal packages that we've seen delivered to date help mitigate those second round impacts through the economy, and we don't get that cascading up influence that we normally see in a recession as it flows back up through the rest of the economy as small firms get destroyed, then this additional packages that we see unveiled into the end of the year will help build a little bit of confidence that the fiscal fade that is currently embedded in the numbers can also be somewhat navigated. We're not overly bullish on the growth environment. We think we're reasonably realistic, but we do think that the destruction of small businesses are going to be far less than what otherwise would have occurred without these packages. And we're much better placed, I think, in the second half of the year to see some of these businesses which are being heavily discounted by markets start to reflect more of their through the cycle valuation. With that, I'll hand back to Vito and hopefully answer some of your questions a bit later on.
Many thanks, Tim. It's now my pleasure now to introduce Joel Fleming. Many of you will know Joel, but for those that don't, Joel is responsible for Yarra's microcap strategy. Joel was previously with UBS Asset Management and moved across to Yarra following our appointment as manager of UBS Asset Management Australian Equities Funds in December of 2018. He's circa 20 years investment experience. His fund has delivered 9.5% per annum net since inception, representing about 480 basis points of outperformance, which is an outstanding measure on any account. Suffice to say, we're really happy to have Joel as part of our team here at Yarra. And his appointment has really rounded out our domestic equity offering, enabled us to offer investment products across large, mid, small, and now the micro cap universe. So thank you, Joel, and over to you.
Thanks, Vito. And thanks, Tim. I think you've raised some really interesting points looking to dispel some of the many misconceptions around the small businesses that make up our economy. A shock such as we have experienced provides a lot of opportunity for microcap companies to build successful businesses resulting from change. So I might start with some high-level observations. While the market has recovered strongly from the recent low point of March 23, we remain positive on the medium-term opportunities that exist as a result of COVID-19. Firstly, we believe growth will be a rare commodity as we adapt to a new normal and understand the impact on unemployment and consumer spending and the wider implications for GDP growth. Secondly, the economy will see structural change, whether it be increased digitisation or a change in market structures given the makeup of competition within sectors. This will provide both opportunity and threat for business. The outlook for yield also provides an interesting backdrop with much debate around future payout ratios and underlying levels of dividends. This again supports capital growth, represented by businesses that are growing strongly, being applied a premium. The decline was rapid from the February 20 market peak to the bottom on March 23rd. This period represented peak fear on the profile of the health and resulting economic impact on Australia. The strong outcomes to date on infection and the reopening of the economy have provided the market with confidence as we re-emerge from hibernation. Children are heading back to school, shops are opening, and many aspects of normal life are becoming evident. This is not to say there won't be deep scars from this experience, with some companies' medium-term outlooks diminished significantly. It's interesting to note that while the initial sell-off was indiscriminate, the rebound has favoured those more liquid, smaller microcap names, with investor concern around any further issues seeing the liquidity premium being highly valued. As we return to surer footing and understand how the economy will move through this period, we expect to move further down the market cap and liquidity spectrum by investors as they seek to add portfolio risk and leverage to the rebound. We also believe that the changes that will occur will create opportunity for those smaller developing companies to carve out niches for their offerings, resulting in strong medium-term growth potential. A few broad observations. Smaller microcaps underperformed on the way down their large cap peers. However, the post-March 23 period has seen significant outperformance, adding risk due to confidence in the recovery. Our central view that Australia would likely rebound earlier and stronger appears to be playing through. And much debate has occurred about big structural changes around office space requirements, shopping centre occupancy, supply chains, and domestic manufacturing capability. These themes will continue to evolve over the medium term and create both tailwinds and headwinds for individual sectors and businesses. We are in an environment of highly uncertainty on earnings, the key to valuation. This uncertainty provides opportunity to add quality to the portfolio. It also creates high levels of volatility as company updates provide short-term certainty, allowing investors a data point to anchor to. While the level of capital raisings has been lower in the microcap space than expected to date, we believe that this will remain an attractive way of initiating new positions as we move forward. As has always been the case, risk capital exists to support a solid idea in the microcap space, and this will provide important funding for the post-COVID business builders. So we just move on to recapping the microcap sector. Microcaps represent opportunity. While the latest investing fad gets plenty of airtime, no more obvious than the 60 COVID-related announcements the ASX had to act on due to proclaimed cures or product benefits, there exist businesses that over time will deliver on an opportunity that sees them transition from humble beginnings to one of Australia's top 100 listed companies. Think Afterpay, A2 Milk, Domino's Pizza, TPG Telecom, or Cube Logistics. While much of the universe will deliver poor returns over time, despite much hype and promise, those success stories deliver many multiples of an initial investment. Microcaps offer the largest investable universe by number on the ASX. They touch every part of the economy, which is important in context of the current period of change and disruption and the likely domestic-driven recovery. There are 820 listed companies with a total market cap of $63 billion that sit between $20 and $250 million market cap. This wide opportunity set is further enhanced by capacity constraints in building portfolios of stocks of small size and the resultant relative lack of investor and wider media coverage. There exists significant inefficiency as compared to larger peers. Clearly, the world's outlook for growth has changed as a result of COVID-19. Successful microcap businesses will stand out in this environment, providing growth and a significant point of differentiation. Smaller companies tend to be more dynamic and innovative, with a single focus on a particular niche, whether it be via a key product into the manufacture of infant formula, such as Clover Corporation, or the likely continued shift in online spend from offline, in the case of Temple & Webster. A focus on high-quality management, building a sustainable franchise helps to remove the noise of short-term fads and builds conviction in a business that will prove durable and a driver of long-term returns. With no ETF or passive products, illiquidity, and a vast investable universe, microcap investing is all about active management. If we just move on to the volatility we've seen through recent months, we all have significant personal experience from recent events in terms of changes to our way of life. From the peak of the market on Feb 20, we saw an initial risk-off phase as investors moved away from perceived higher risk, lower liquidity, more speculative positions. The Emerging Companies Index best reflects a microcap subset, and to illustrate, this index declined almost 41% over February and March, as compared to the 29.7% fall in the small ordinaries. As restrictions are slowly lifted and the economy begins to reopen, we have seen the market becoming more optimistic from the deep fear and uncertainty felt through March. While much uncertainty prevails, however, on medium-term earnings and how the economy will perform as government support is wound back. In terms of the journey we have gone through in this time, initial concern on supply chain moved quickly to solvency and liquidity as investors contemplated a potential zero revenue environment. The government response via the JobKeeper package and guidance on tenancy-related matters provided support in a very dynamic environment. Our approach was to test and retest our investment thesis as the facts change, speaking with management regularly on how their businesses were adapting and understanding the key moving parts around the cost base and balance sheet to be able to absorb this shock. Continued channel checks remain a key facet of our process, never more important than at a time of unexpected and rapid change. A core part of our philosophy has always been a focus on the quality of management, the quality of earnings, and the balance sheet. This has served us well during these times and reinforces these attributes as key foundations of our investment process. Too often, a business is underfunded or seeks to take on a market opportunity that is larger than their capability. And given our hard market cap limits on initiating positions within the portfolio, the market decline has increased our investable universe, providing greater opportunity to add higher quality businesses to the portfolio. In terms of number of our investable universe has grown by over 150 names since the start of the year. Many of these businesses were highly rated previously, and while sold off aggressively, their long-term potential remains intact. We look to position the portfolio for a post-COVID environment, businesses that will show strong growth and deliver product and services relevant to the way that consumers and businesses will spend going forward. Now, moving to how we think microcaps will perform in a post-COVID environment. Markets have recovered significantly in recent weeks on an improving outlook as the economy emerges from lockdown, and we look forward to return to some sort of normality. Business updates from Baby Bunting, Clover Corporation, and Alliance Aviation have led to significant positive share price movements, as fear around recent trading have shown to be unfounded and the strength of the business model is affirmed. We expect continued volatility in the short term as investors battle uncertainty around lockdown impacts and how the short-term environment develops. However, while many businesses have performed well during this period, I think those with strong online offerings, the gold miners, and those providing essential services or products, much uncertainty exists around future employment, consumer spending, and the speed at which the rest of the world will begin to open and the lasting damage done. We expect that many businesses will not emerge from this period as government support withdraws and the economics no longer make sense. This may entail complete exits in some industries or a significant downsizing in operations. We see changes to competitive dynamics as a result, and this creates opportunity for those offering a better solution or experience for their customer base. One thing that is certain is that the listed microcap market is willing to back a good idea. To help drive innovation and provide opportunity, the market is willing to fund and support a management team as they seek to build out their business plan. This is an important aspect of investing in the space and can provide the initial entry into an opportunity with significant promise. Key issues to watch in the short term relate to any re-emergence and requirement to hibernate the domestic economy again. The path of the global economy and our trading relationship with China are all areas which add to uncertainty. Our base assumption is that with the opening of the domestic economy underway, many of our portfolio companies are domestically focused, have lean cost bases, and have built their operating platforms on scalable technology. The changing of competitive landscape will provide opportunities for growth as efficient, nimble companies grow their market share in a profitable way. This growth will be well rewarded by investors. In conclusion, we believe the time is opportune to look at microcaps as part of a broader portfolio. COVID will have long-lasting impacts and be the catalyst for much structural change across the economy. Small, nimble businesses with a sound financial base and a laser-like focus on their customers are well positioned to take advantage. An environment of lower growth will see a premium applied on businesses that are delivering this rare attribute. This is also likely to be reflected in M&A activity, as larger businesses seek to provide growth options in a time where this is difficult to deliver organically. Many businesses will not survive these changes. A core focus on balance sheet and cash flow, backing of management that are able to adapt and think strategically, and an awareness of the evolving nature of consumer wants will help protect against investing in failures while providing a sound basis from which to identify those that will become the future leaders in Australian business. With that, I'll hand back to you, Vito.
Thanks, Joel. I think we've got some time for some questions, so we'll work through 3 or 4 questions in the remaining time allocated. Tim, first one we'll direct to you, and the question is, are you still holding a firm view to a V-shaped recovery? There seems to be a large disparity in the market between the various economists. Where might you be wrong?
Yeah, look, I think the way to categorise our forecasts, and remember our forecasts were originally conceived back at the start of March, where we're looking for a -5 for this calendar year and +7 in the next calendar year. As it's come to bear, we saw a number of people getting far more bearish than that, and on what would happen this year, and then we also had the RBA print out their own numbers, which were initially conceived as being more bearish, and have subsequently come to a view that now looks very much more in line with ours. Plus, they're signalling the potential to move towards their high case scenario on the earlier release from lockdown. So, if anything, I think if there's a bias amongst the economists at the moment, is to be upgrading their views, not downgrading their views. I think where people are, and we see most of the discussion in the newspapers, the interpretation of a V-shaped recovery meaning that you go back to where you were. That was never a definition of a V-shape that we subscribed to or identified with. Our definition of a V-shape was always, as we said, small V. You mechanically get a recovery through the second half of the year. People have underestimated the size of the stimulus vis-a-vis the labour income destruction. So in many ways, you delay the adjustment into the end of this year and early next year. And if we do more stimulus and help mitigate that drag, then we come away with an okay-ish type environment. It is not off to the races by any stretch of the imagination. What the equity market has done, I think, is quite correctly has embraced the idea that the recovery probably will happen broadly in line with our forecasts. But I would hesitate to suggest the equity market will continue to do that for an extended period of time. They're looking 9 months out. 9 months out is around about where you see the peak of the stimulus rolling down and into the end of the year, I think fairly soon you'll move into a consolidation phase for the market as they realise that, yes, the growth is now somewhat embedded and it's a little bit more challenging to look into 2021 and look for ongoing material growth as that fiscal fade kicks through. So where could we be wrong? Yeah, sure, there could be a second wave. What's encouraging, I guess, at the moment is we're not seeing any uptick yet in terms of the infection rate. So that's both here and offshore for those that have opened up earlier. So that is, I think, is quite encouraging. I think secondly, we can all see the high frequency data, with the exception of things like restaurant bookings and the like, which are looking very slow to come back. We are seeing some very encouraging bounce backs in mobility type data. And ultimately that first phase of the payments that have gone out, a large chunk of that we can see even from survey data has been saved, which gives you the capacity to run that down in coming months. So if we're going to be wrong, it's largely around a second wave, or if we're going to be wrong, it's probably an escalation of geopolitical events that are out there at the moment, which has caused a broader risk off bias across markets.
Great, thank you. Joel, next one directed to you, and it's more around the depth of liquidity in your universe. And the question is, what is the depth of liquidity in the microcap universe been like over the crisis period?
Thanks, Vito. Well, as I alluded to, there's certainly been a focus on those more liquid part of the market. But, you know, there's some interesting statistics out there about the opening up of new trading accounts and some reports on the level of day trading that has occurred. It's actually been quite buoyant across the board. There's been a lot of liquidity across, you know, most of the names. Obviously, the higher liquidity names have benefited the most, but in periods of panic and fear, you expect a real widening in spreads and liquidity to become very problematic, and that's certainly something that we haven't seen. So, you know, I think that you know, as markets get onto a surer footing, that will continue to improve. And I think, you know, increasingly people looking for growth, they are having to look further down the market cap spectrum, which, you know, does result in lower liquidity positions.
Great, thank you. Perhaps one more each. Tim, what does the JobKeeper accounting error mean for our domestic recovery?
Well, it's an interesting one, isn't it? Because it's when we call it an accounting error and blaming the ATO for it, bear in mind that it was always set at 130 billion, and it was always talked in terms of coverage in 6 million employees. So it's not people filling in a form incorrectly. It was always an error at the Treasury from the get-go. The error itself, though, as I sort of touched on in the presentation, won't impact the way that we've seen the forecast unfolding. It gives the government some relief in the sense that it has this additional quantum of money, 60 odd billion, that it can utilise down the track to smooth off that fiscal fade. It's going to be very interesting to see how they allocate those funds. There's talk of it going more towards the tourism sector. There's talk of it going towards construction. Now, state-based incentives are normally the way we do the housing construction incentives rather than federal, but the Treasurer has already indicated some desire to do something there. And I'm sure there'll be many more. But it gives flexibility, which I think is good news. And it probably gives a little bit of relief that we're not creating a whole new wave of zombie companies. There is an element of that, and there is a degree of discomfort around just how broad-based and the easy access, and no doubt the exploitation of this program. The intent was just to get the money into the economy. There is going to be a review in June to tighten up the restrictions. And I think when we move into the end of the year, its JobKeeper Mark II will look very different to this version of it. But I think the way it should be read is that it's not as though there's less stimulus in terms of the net payments getting through to the economy, as we've previously articulated. It just gives the government more flexibility as we look into that next phase.
Great, thanks. And one final one for Joel. Joel, can you give an example of a stock where you've held your nerve, where perhaps others haven't?
I think RPM Global, the ticker's RUL, is a good example. 235 million market cap, last count $33 million in net cash. Very well managed business that's been investing in their suite of product offerings over the last couple of years. They provide software to the global mining industry. The mining industry has obviously continued to operate through this period. And this software delivers productivity benefits across mine design, scheduling, operations, equipment maintenance. So we kind of think it's a business that it's at a tipping point in terms of the short-term sales environment will be affected by the fact that your sales team can't get on planes and get onto site, but they've built up a really interesting suite of products. We think that the adoption that we've seen in the market thus far is gaining traction, and we think it's a business that's really at one of those tipping points in terms of adoption, and the addressable market they have is significant. You've got a well-managed business, a very strong balance sheet, and it's one we think that's off the radar as well, that it's not very well recognised by the broader market. So we think that that's a stock that has significant potential over the long term, and this COVID impact doesn't affect those prospects in the long term.
Great, thank you, Joel. That brings today's session to a close. I guess firstly, on behalf of Yarra Capital Management, a massive thank you for listening to today's recorded session. We really do appreciate your ongoing support. If there are any questions or information that you'd like following today's session, please either contact myself, Nick Green, or Amala Copian in the first instance. We're more than happy to answer any questions, or perhaps even arrange a follow-up discussion with the our various team members. That's all for today from us, so thank you and have a great day.